Welcome to Market Monday from the investment team and the trust department at the First National Bank. We're going to talk about a few things today, starting with the Federal Reserve and their recent policy action, what some of the upcoming economic data is, how what we're looking at in the economic data has changed, which is material, but we'll get to that. And then we'll talk about implications for the investment landscape with respect to equity indexes and the rates markets. So starting things off, at the last meeting, the Fed did go for the 50 basis point rate cut, which they had been widely discussing and which interest rate markets were widely expecting. Whether it was actually necessary is going to remain to be seen. However, the Fed typically has reserved 50 basis point rate cuts for situations where they see some pretty extreme danger to the economy. So it is a bit of a note of caution, and it is worth noting that whenever the Fed has begun a rate cutting cycle, it has led to increased turbulence in the market and an increased likelihood of downdrafts. So we're now looking at something entirely different when we look at the economic data that's coming on the horizon, because for the Fed to have dropped by 50 basis points, they must see something that we so far haven't seen in the wider, analyst and portfolio management community. So going forward, looking over the next couple of weeks, we're going to get some key data. And whereas before we were looking at inflation as a key driver, now we're going to tilt our interests toward what's going on in the economy. So we're going to see things like manufacturing take on increased performance. What's going on in the labor market? Are jobless claims starting to tick up? This 221,000 that's expected at the next reading isn't really that extreme by historical standards. If we're seeing significant deterioration in the employment situation, that's going to be cause for concern. If we're seeing manufacturing slow down, that's going to be cause for concern. If we're seeing, factory orders and durable goods orders, these numbers take on increased importance in this type of potential market environment that is suggested by the Fed's 50 basis point cut. So, we'll see non-farm payrolls this Friday. That's expected to show a growth of 146,000, which is relatively weak by recent standards, but not relatively weak by long-term standards. So, we're going to be watching what's happening in the labor market, what's happening in consumer demand. Is that starting to taper off, or is that going onward? CPI, Consumer Price Index, and PPI, these numbers, Producer Price Index, these numbers are important, but in the context of are we worried about inflation as much anymore? The Fed clearly is not. By cutting rates by 50 basis points, even into a situation where inflation in the core numbers seems to be at least ticking up, they're pretty confident that inflation's under control to have taken that policy action. So we're going to be less concerned with this number, as we believe many of the market participants are. Instead, they're going to be focused more on the sentiment indicators and what's going on that illustrates the demand situation. So we're going to be paying close attention to that. Let's move into equity markets. The S&P 500 is trading basically at all-time highs, but it's important to note that it really can't seem to get above this level that it's trading in, and it's a tight level. That's not really a good sign for what the immediate future holds, particularly in light of these rate cuts, which suggests that we need to be cautious about increasing volatility. And, technically the market has been looking for that cut, and it was priced in, and we don't really have any additional information beyond the fact that they did that. So, looking at the volatility index, that is starting to tick up as well, indicating that investors are looking for protection from potential, volatility in that market. And so we're going to keep a close eye on volatility, but we are expecting a turbulent fall, particularly when things align. So September and October traditionally are the months where market turbulence is most likely. March gets an honorable mention, as we've said before, but typically, if we are going to see significant volatility, it's going to come in September or October. And, with us being there, with the Fed embarking on a rate cutting cycle, which is historically almost every time, if not every time, resulted in bouts of volatility. We have these things coincident, and we have a market that's trading basically at all-time highs. So it's worth paying attention to and being ready, if there is a pullback, to understand that we're taking a longer-term view. We'll wrap up with that like we typically do. But the rates market, let's talk about that. So treasuries are down pretty substantially from where they began the year, and even a month. And, we've got 10-year paper, which is down, 12 basis points from a month ago, 10 of which happened, since the beginning of the year. So we've seen rates kind of go up and then down over the course of the year. But looking out to the curve, we're starting to see this normalization. The slope of the curve is ticking up slightly at the longer end. And even here, this is noteworthy out at 30 years, where rates have actually gone up. That suggests that bond market participants see potential for inflation to remain higher for longer, given that the inflation risk premium is baked into the yield pricing. And what is likely ahead, because the Fed can move this rate, the short-term rate, and these rates are all kind of derived from that short-term rate. However, the Fed can't really manipulate these unless they're buying and selling securities, which they do sometimes. That's called either quantitative easing or quantitative tightening when you see that discussed on the news. But in any case, what are they likely to do? The current policy rate, 5%. This table here illustrates what the probabilities are based on positions in the market of interest rates being at certain levels. And it basically says, market is expecting another couple of hikes, couple of cuts between now and the end of the year, showing that, the implied rate based on market positioning would show 250 basis point cuts, but we don't see that happening. So if that were to happen, that would be raising some significant caution as to what the future holds, not be reassuring to markets. So with the market participants basically positioned for an aggressive rate cutting cycle, there is some risk in the marketplace, again, that they get disappointed by what the Fed does. The Fed has still maintained that they intend to be data driven, although they're saying that they see the risks more on the downside to the economy now than they do on upside to inflation. So we're going to be paying attention to that. Treasuries are still relatively good by longer term standards. 10-year paper yielding almost 4%. And, that is not a bad rate when you consider the era of almost 0% interest rates, particularly in treasuries, that we've been through in the recent past. Corporate bonds, they're actually yielding relatively similar. Yes, in the short-term bonds, in the short part of the curve, rates have come down pretty dramatically. Less so on the longer-term end of the curve, which again isn't as influenced by these short-term rates. And corporate bonds have a default risk premium for the risk of taking corporate credit risk. So that's baked into the yields, and you can get 10-year paper still yielding 4.6. That's great by our recent standards when interest rates were near zero. So income investors are getting paid. That's good. Back to the market. This isn't very great for the future, the fact that we can't seem to get above this area. But again, if there is volatility that comes in from seasonal forces, from the fact that maybe the Fed has seen something in the economy that we haven't seen yet in the broader community or the markets, it doesn't really matter over the long term, because we're looking at this type of period where even when you have significant market events, you have a great end result just by continuing to stay on your disciplined long-term plan that takes these periodic pullbacks into account. Are we going to see a volatile fall? We think the odds are pretty high. We also think the odds are pretty high that we could potentially see a recession. However, if we do, these aren't going to be material to your long-term plans, and we want to make sure that we stick to those. So with that, hope you found this video useful. If you have questions and concerns and you'd like to talk with us, we love to talk about this stuff. And on that note, have an excellent day.